We stopped with effects of taxes and we'll start with effect of depreciation. So depreciation is a non-cash expense. It is a part of the original cost of asset that is written off. Now this expense is deductible from profit. And when this expense is deducted from profit, the profits will be shown as less. And then the implication of tax will be also low. The income tax effect will also be reduced. That is, tax liability will be also less. But there is no actual outflow of cash because it is a non-cash expense. Now, actually, this benefit of tax, this tax saving is called as depreciation tax shield. There is no actual outflow, but you can reduce the expense from profit, which will reduce your tax liability. And this is called as depreciation tax shield. Now, when you do problems, you will find CFAT, cash flow after tax. That is, first you deduct depreciation, you calculate tax based on that, and then you reduce tax also, and later you will add back this depreciation amount because there is no actual cash outflow. So that is effect of depreciation. Okay. Next is proceeds from sale of assets. That is, we purchase a new asset and we replace the old asset, right? So we get some amount as proceeds from sale of the old asset. It could be some scrap value or some resale value. So that amount is reduced from the amount we spend for purchasing the new asset, right? Because only that difference is to be considered. Next is effect of overhead and other indirect expenses. That is, these expenses also have to be considered and accepted only if there is a change. If there is a change from the previous overhead cost and indirect expenses, like as we saw in the incremental cash flow concept, we just have to look at the changes or differences because only that will have an impact on the cash flows. Next, types of cash flows. Here, cash flows are the most important concept to understand in this chapter, right? Capital budgeting. So we're going to learn about the types of cash flows. And the first one is initial cash flow or initial investment. That is the investment that we make in the beginning. It is the outlay of total cash flows that we make in the initial period. So it is usually a large amount. And what are the components which are included in initial cash flow? Cost of new asset. And this cost of new asset includes insurance, freight, installation charges, etc. The second thing is opportunity cost of the assets. Third, increase in working capital or additional working capital. So all these costs are included in this initial investment. And another thing is that in case of replacement projects, you actually replace an old asset with a new asset. So you get a scrap or a salvage value. That amount is also reduced from the investment in the new asset. Okay, so that proceeds is reduced from the investment in new asset. So these are the things that is included in the initial cash flow or initial investment. The next is net annual cash inflows or operating cash flows. The initial investment will give you returns in a number of years in the future. So those returns or those cash inflows are net annual cash inflows. On an annual basis, usually you will get inflows or returns or the benefits back. So that is the cash inflows or the operating cash flows, the returns that you get. And finally, the terminal cash flows. The terminal cash flows is the estimated salvage or scrap value realizable at the end of the life of the project. That is, when you sell your asset, you get a scrap value. Or it could be the working capital which was invested in the beginning but no longer required. So that also you can actually dispose and you get some proceeds out of that. So these two, the scrap value or the excess working capital, that becomes the terminal cash inflows. Okay. So these are the types of cash flows. Next is investment evaluation criteria or methods, or you can generally call it as methods or techniques of capital budgeting. That is, these techniques helps you to determine which investment opportunity is most profitable. So you have to find the most profitable one. So you have different methods to analyze it. It can be categorized into two: traditional methods or non discounting techniques, and time adjusted method or discounted method. So, non discounting itself explains to you that there is no time value of money considered. No time value of money is not considered. And the first method is payback period method. Okay, it is also called as payout method, payoff method, replacement method, recoupment method, etc. Second, post payback profitability method, and ARR, average rate of return. Time adjusted methods are very important: benefit cost ratio or profitability index method, NPV, net present value method, IRR, internal rate of return method, and NTV, net terminal value method. The second and third methods are the most important. In general, time adjusted method or discounted method or the modern methods are most important. Payback method is also very important. Okay. First, we shall see about payback period method, which is also called as payout, payoff period, recoupment period, replacement period, etc. Now, what is this payback period? It is the period required to recover the initial cost of the project. You have made an investment and you need to at least cover up the investment cost, right? At least that cost you have to get back. So the period to get back the initial cost is called payback period. Okay. Now there are two ways in which you have to calculate payback. That is when your annual cash inflows are equal and when your annual cash inflows are not equal. We can also say that payback period is the break-even point where your returns are equal to your accumulated returns are equal to your investment. So that means no profit, no loss break-even point where you're able to cover up your investment amount. So let us look at the first situation when annual cash inflows are equal. The formula for this is payback period is equal to original cost of project, that is your investment, original cost of project divided by annual net cash inflow or your net earnings. So you're getting equal annual cash inflow. So here that is what annual net cash inflow. Okay, so original cost of project or your initial investment divided by your annual net cash inflow. Now look at this example. A project involves a cash outlay of rupees 5 lakh and generates cash inflow of rupees 1 lakh annually for 7 years. Okay, so here your initial investment is what? Rupees 5 lakh. You are getting rupees 1 lakh annually. That is your inflow is same. You're getting same rupees 1 lakh every year at the end of every year for 7 years. So here we have to calculate the number of years to get back the rupees 5 lakh at least, right? To get back at least or to cover up at least your initial investment. So payback is equal to 5 lakh divided by 1 lakh, which is equal to 5 years. So you need 5 years to get back your initial investment, right? It is just very simple.